Good morning, and welcome to Candid Coffee from RIA Advisors, a live, open forum to address your money, retirement, risk management, and how to protect your household against financial vulnerability in a post-COVID world. Send your questions to question@realinvestmentadvice.com. Now, here are your virtual financial baristas, coming to you live from an undisclosed secure containment location, Richard Rosso and Danny Ratliff.
Hey guys, welcome to Candid Coffee. Thank you guys for joining us this morning. I know it's bright and early on Saturday. A little bit, I think we've been expecting some rain. Still not here yet, but I guess we'll get there at some point. It is Houston for most of us, so it may be raining somewhere, just not where you are. So today's really informal. This is our third Candid Coffee. This is really off the cuff, no planned agenda. We did get some questions in. In fact, I kind of moderate. I send some stuff over to Rich on the fly. So if you do have additional questions as we're going through this, please go look at your control panel. You can ask a question there. I think we've got enough that's going to get us through this hour. But and we do appreciate all of y'all's feedback and all that's going on right now. I think it's important to make sure that we all stay on top of finances, understand actually what's happening out there, and putting our best foot forward each and every day. But so, Rich, you want to start off with markets, where things are? I know it's been a crazy couple of weeks.
Well, yeah, and I want to thank everybody for being here on a Saturday morning. Hope you're not getting rained out. And one of the things you have to keep in mind is we're going into a transition for this COVID economy where the stimulus is gone or going away. Danny and I are big believers that some form of the CARES Act is never going away, which means that eventually some form of unemployment compensation above and beyond what we expect will continue. People will be chronically underemployed. The problem is the market is not focused on the numbers. It's focused on the improvement and the hope in the numbers. Not to all gross you out at breakfast, but I'm good at that. The economy was in the toilet. Now we're on the toilet seat. How do we get off the pot? The market's not focused on that yet. So financial reality and market fantasy are going to have to mold. What sector rotations occur, what happens is really anybody's guess. That's why we watch it every day. We all have meetings every day. We are very nimble in portfolios every day. But most important is we have to look at the data for what it tells us. Even though we're invested, because technically it says you must be, fundamentally we understand that is our ground. And we just want to make sure that you understand that through the summer, especially in, say, for example, August, September, when some of the newer numbers coming in through this second wave of COVID, and cities and states shut down, the market is truly not really focused on that yet. And then we're going to be into the election. So anything goes here. This is the Wild West. We're just trying to be out there patrolling the streets during the process. So we want to provide these candid coffees to really talk to you candidly. There's a lot of junk out there, a lot of proper talk in the financial industry that just guides you in the wrong way, in the wrong path. We want to make sure you're on the right path, because the way you fight this war, and we do think this is war, is in your household, at your dining room tables. Danny and I want to make sure we're your generals or your board of directors, and we help guide you in the best objective way that we can. So thanks for being here. We hope to do one in the beginning of September as well. And August 8th, our retirement right lane class online. Your butt's going to be sore, 2 hours, 9 to 11. But I will tell you, you will gain something about Medicare, Social Security, tax-friendly retirement income strategies. You will learn quite a bit. If you're 5 to 10 years from retirement or just retired, this is the class for you. And you can sign up at Real Investment Advice or RIAadvisors.com.
I think we're giving that a little bit too long of a time frame there, Rich. Usually it's about 2 hours, but we're typically doing these live as well. So We tried to make these very interactive, where lots of questions. I bet we're talking an hour, hour and a half. It's just you and I going back and forth. But we'd love to have you guys there as well. So, common theme: you're out of the market. You just have cash you want to put to work. What do you do? One question is if I have cash that I would like to put to work, but also not put the money at excessive risk of losing 25% or more in a market downturn, do you recommend waiting for a partial correction of the equity markets as they are currently priced / overpriced, or is sitting on the sidelines with low fixed income return options and the likelihood of increasing inflation the greater risk at this stage?
Think about it this way. Do you want to jump into the cold water all at once, or you want to dip your toe in and slowly ease in? This is a slowly ease in market. Advice I gave to a couple of months ago, because the market had recovered some part of what it lost, was listen, give me your dollar amount. You have $20,000 you want to place into the market. Okay. Well, none of us have a crystal ball. So here's what I'm going to do based on how overbought it is. I'm going to put $5,000 in, right? I'm going to at least dip my toe into the water, because the markets could go higher based on momentum, right? As opposed to waiting for some sort of correction and jumping all in. I value averaging. I ease in 5,000, then I'll wait for a dip or a consolidation. That's where Lance's newsletter is really helpful. He will show if the market's overheated or it's starting to lessen. I equate it to an oven at Thanksgiving, right? Because you are throwing $5,000 into an oven at 400 degrees. But it may not burn right away, right? But I didn't risk everything. Now the oven starts to cool off. It doesn't mean it's off. It starts to cool. I can add another 5,000. You see, this takes discipline and rules, which again is very time consuming. So I would say if it were me, and I said I need to get in the market, I have cash, I would consider what percentage I want to place in today, and then look at it from month to month. And I'm not going to dollar cost average. I'm not a big fan where I'm just going to throw the money in like a robot. I'm going to wait for some sort of event to add the next 5. So I still think you can do it, but you're not going to say where you were at the bottom here and say, I'm going to put half of my money, right? I'm going to put.
Well, that's the thing. I mean,
so everybody's got a different rule, right, Danny? I mean, I'm just saying is there's a way to do it now without having to wait for the big event, because the Fed and the way they underpin the markets prevents the big event. I'm not saying you won't have an event, but the Fed is there to backstop the market. Not correct. I don't say it's a good idea at all. Okay, we can have another 2 hours of Candid Coffee on how much that is not right. But you can decide to do that. Also, look at markets that haven't done as well. Like if you look at the S&P 500, right, Danny? If you extract the 5 biggest tech companies, the Amazons, the Googles, where the heck have you been since 2017? You haven't gone anywhere.
Yeah,
right? The S&P is market cap weighted. So these companies have taken over, and companies don't split. Market cap keeps growing. So the thing we have to keep in mind is maybe I put 2,500 into an international market. It may take a lot longer, but they just issued a massive stimulus package. We have a little bit of international in the portfolio right now. We're watching closely. We haven't been international for years. So there's a way to say, or I put 2,500 into a total stock market index, which gives me some small cap stocks, right? What's nice, if you own a brokerage firm account, you can buy a lot of the ETFs with no commission, low cost. If you need any help on those kinds of ETFs that you want to look at, you can email us questions, email Danny or me, Lance. We're here to help.
I think you made a couple of really interesting points there, Rich. Dollar cost averaging seems to be the easy way that most advisors just say, hey, you know what? You don't know. What if the market's even higher in a month? What if it's higher in 2 months? That could be the possibility if they do pass additional stimulus, like you just mentioned.
There are many studies out there. Many studies out there. You've read them. I've read them. Dollar cost averaging doesn't work.
Yeah.
Wall Street created dollar cost averaging to get you as the client off their backs.
That's
and
right.
Just do the thing. There is no outperformance from dollar cost averaging. There's no effective performance. It takes a value averaging approach where it's going to take more time to place money in the market. So if you look in a month from now, and I have this other $5,000 tranche, and the market's still overdone, guess what I'm going to do? Nothing. I'm going to wait and see people that we're a purchase society. We like to buy. So I want to buy my stocks. I want to own this index because I'm an American and I like to buy. Well, guess what? You might have to postpone your buy. And he's taking off his robe.
It's hot, man.
Listen, I got this terry cloth robe, everybody. This thing, first of all, that's my dad's initials. My dad died in 93. He bought this robe in 86. This robe is older than Danny. So,
not quite.
Well, almost. But what I'm saying is, you might look at the market in September for the next tranche and go, you have to have the discipline of an investor to say, I won't buy here. I have my first 5,000 in, seems to be doing okay. Market's way extended. I'm going to wait. What does September bring? Mark it on your calendar. Look at it on a Friday, like mid-morning. Do your homework, 30 minutes. It doesn't take a lot. But Wall Street makes it sound like, oh my gosh, this is so much. It's work for Wall Street because they have goals and sales goals to hit. They can't be bothered.
That's right.
This is your money. You need to be bothered. So I'm sorry to me interrupt you.
So with that approach, though, that's right. So if you're fearful, they say, look, don't put it all in. Let's do a little bit each month for the next 6 months or 12 months. And unfortunately, like you mentioned, studies show that it just doesn't work like it used to. And so you do have to be cautious with that. The aspect of buying things because they're low, sometimes they're low for a good reason. So don't just go out there and willy-nilly just go throw money in because you have an asset price that's depressed, because sometimes there could be a problem. You need to make sure there's something behind it, or a sentiment or some fundamentals that are suggesting that this is actually a really good buy and you're going to see a leg up. So don't just go out there and say, okay, well, we're going to take the worst performing index and go buy that, because it may continue to be performing very poorly in the future. So we can spend a lot of time on this topic. Let's kind of keep this rolling a little bit, Rich. So another thing is, next question was, I always hear you guys talk about taking profits and setting stops. Is there a general rule of thumb for what percentage of a particular stock you sell when a stop is met? For instance, if I have 50 shares of a stock and I put in a trailing stop at 10%, what percentage of shares should I put in for this sell? I want to be able to keep some shares working in case there is a reversal. Is it 30, 40, 50%? Or do you haven't set where there's a, if you get stopped out, you just have to be mindful and watch and be ready to go back in.
Listen, and Danny, you understand our rules. Winners want to run, and you let them run. So if I have a wild horse that I'm riding, I want to pull back on the reins on occasion. Doesn't mean I want to get off the horse. People have an ability, or they have a tendency, investors, to sell too soon. They tend to hold on to their losers too long, sell their winners too quickly. This is technical analysis 101. So what I would say is that whatever rule works for you, if you have a rule that says I've made $1,500 or $2,000 and I am above a certain parameter of where I need to be, we put tolerance bands around positions. We let them sort of ebb and flow or billow out to a certain point where we have technicals to give us the fence that the horse can run. If the fence starts to expand too much, we cut back the fence. We won't sell the entire position unless there's a fundamental underpinning of something wrong. But for those that are looking at the technical analysis of it, you might just say, I'm going to look at a 15 to 20% profit, right? And set my stops to just remove the gains that I've had and keep my core. There's nothing wrong with selling or trimming away surgically a winning position, but your rules are your rules. If you said, listen, every time this thing makes 5-10%, I say go by the beta of the stock. And what I mean by that is if it's Procter & Gamble or Kroger or Pepsi, which has a beta of less than 1, which means it moves more sluggish than the market, maybe I can give myself a little more room, right? Because heck, it's not going to be this wildfire, right? My rule might be where my stops are wider to let it move because I'm not worried. If I'm owning the Bitcoin ETF, what am I doing? Volatility, right?
Yeah.
I'm gonna shorten that. In other words, the wilder the horse, the tighter my reins are going to be. The tighter my grip, and the tighter and the stronger I'm going to pull it back. So think about this way: every investment is a horse, wild horse or tame. They have their own personalities, and you can guess in your mind what those personalities are based on the stock that you want to invest in. If you're investing in some highly speculative small cap stock, that's your wild pony, right? I mean, so it's no important. There's a threatening jogger, by the way, that's running by the house. So the dogs feel the need to protect me if you hear barking. So would you say, Danny, that's a good way to think about it? That if it's a company, even like Apple or again, a Pepsi, Coca-Cola, Procter & Gamble, something that's consumer staples and beverage, maybe I don't need to have such strict sell rules on profits, even though I want them, where I might put a tighter rein on profits with wilder stallions. Now, the thing I will tell you is people make a common mistake, and I just mentioned it earlier. They sell everything. They sell their winners too soon, and they keep their losers. What if I just trimmed my winners? I didn't sell it. I feel good. I took profits. If it goes higher, I still own it. If it goes lower, I look like a genius. Emotionally, it's a win-win for me. What do you think?
Yeah, no, I love taking profits because I think that's the one surefire way, that you're actually going to capitalize on that gain. And now there's times you can look back and obviously say, oh, shoot, I wish I left those funds in. But on the flip side, you're giving yourself that peace of mind to know that you're participating and you're actually taking advantage and taking those gains for your benefit. Whereas as wild as we've seen markets swing, Rich, I mean, you've seen how, you may wake up and the market's down 7% after a month of great returns, and vice versa. So we do have to be cautious. I think that taking those along the way ensure that you're capitalizing on this market while we have it, because this may not continue to last.
Think about this as a harvest. If you're growing a tree and you're growing beautiful fruit, you made a good decision and you got all this bounty. If you don't take the fruit off the vine, it rots. Sooner or later, investments move in and out of spotlight. When I was a kid, there was always a comedy show where the comedian would be at the microphone and the light would be on him, and then the light would move and he'd have to move to the light, and then the light would move and he'd have to move. You know what I mean? It was sort of funny because he'd be running around the stage. Stocks fall into this spotlight and then they go into the shade. If you were lucky enough to find the stock in that spotlight, understand eventually that stock, that light's going to move. So trimming your profits, and again, there's no magic rule. Now, if you go to Real Investment Advice, type in investment rules, you'll see some of the rules that Lance likes that you might want to employ. I mean, we write about them all the time. At least it'll give you a starting point as far as the tenets that he provides.
You can also go to survival guides. There's lots of different guides there at realinvestmentadvice.com. They'll give you, from a risk metric to the planning specific side of things. We're going to give you all of that information. So don't forget to go check that out. All right. So moving on, great question here. So Michael Liebowitz, one of our portfolio managers, he's typically on our Thursday radio show in the morning at 6 a.m. on AM 700. And he mentioned that the bond proxy component of a 60-40 portfolio would not have the protection that it once did before bond yields declined if the market collapsed. What suggestions are there for protection, and why this sentiment? I'll take this real quick. So the last time we saw the market contract, in a significant manner was back in February, March. Yields on the 10-year just in general and interest rates were much, much higher. So generally speaking, we do see some of that inverse relationship. And when you get that flight to safety, we see yields start to get pushed down. Yields are extremely low. I'm not sure where we closed at yesterday, Rich. I was in a meeting all day, but where were we on the 10-year? Like 0.58?
Something like that. Mm-hmm.
So
who would ever thought that would have been the case, right?
Yeah. Well, and we've seen it lower than that earlier in the year, back in March. Then we saw it get as high as almost 1% again. Now it's came back down substantially. And here's going to be the sentiment. If things open up, there's a vaccine, we get good news, and maybe we get better than expected data, more people, just kind of like we saw this ebb and flow in the sense that we had really bad numbers and obviously open the economy and things shoot up. Well, yields are likely going to spike. But if we go down and we go down from where we are today, there's not a whole lot of room for them to run, meaning that the bonds won't provide you much price appreciation. And as the yields continue to drop, especially if you own funds or ETFs, where they're constantly having to exchange these for new ones, your yield's going to start to creep down over time. So it won't provide you that protection that it once did when rates were much higher. And so that is what the sentiment is there. Now, where do you go? This is a daily topic between us. I mean, every day we're having this discussion on where do you go next? How do you protect clients' assets? How can you still provide yield and return in this environment of extra low rates? So, Rich, maybe you want to cover a couple of the ideas that we've looked at. I think this will also segue into potentially some other questions that we've had as well.
First of all, you have to realize that based on where valuations are, I'm talking about real earnings, valuations, your returns on a 60-40 portfolio over the next 10 to 15 years is going to be very poor. We've been preparing for this since 2018, and you can explain 90% of the variability of returns over time by the cyclically adjusted price earnings ratio, which we follow. Actually, Lance does a 5-year tape or ratio that gives us a better indicator of how overvalued stocks happen to be. That doesn't mean you're going to crash tomorrow. It means that perhaps your forward returns for asset classes are going to be less. So if you're trying to create income in your portfolio and protection, some of those rules here are going to change, and it's going to be very frustrating. We talk, to Danny's point, among the group, we talk about it every morning at 7:30. It's one of the biggest conundrums we have. How do we create income? We don't want to go out and take too much risk and to do it, but is maybe stocks the way to do it? We are firm believers that interest rates along the yield curve are going to go to zero. I've been saying since I was at Schwab 2007 and 8, you are going to be shocked by how low rates go for how long. And I feel like I've a broken record. And Lance has been saying the same thing. So you're going to have to create or understand is that you can't just build a portfolio and say, I'm going to collect my income and let my principal sit. You are going to have to look at capital gains, principal reduction, perhaps alternative types of investments like annuities to create the income stream that you're going to need. See, we're going through a period, and we have been since 2007, and our heads sort of came out of it. But we are looking at a place of what I call financial repression. So we just put a chart up. I didn't know we were going to do that, but that's cool.
Well, and this is actually from 2017, Rich. I actually just went on to and Googled a Cape scatter chart, and this came up. One of our charts, one of Lance's. And
yeah, so what it shows you right now, you're closer. You are right on that 30 line right now. You are on that 30 line here. Notice where a lot of your returns fall. Yes, you do have some returns that are above 5%, but most of your returns are going to be around that 0 line. From year to year, your guess is as good as mine. Over rolling cycle periods, 10, 15 years, you will tend to follow the math of these lines. Notice in 2010, right, when PEs were 17 times, look at where you scatter. Look at where returns are, right? That didn't fare well in 2010, right? You were scared to death, but look at look at where your regression is. The more you go out to 30, 32 times earnings, 35 on the bottom there on the PE10, look what happens to your returns. If you are in accumulation, you're just starting out. Your greatest returns are not going to come from stocks. They are not going to be this panacea, this magic elixir to overcompensate for bad financial decisions. The return is going to come from your habits in your household to manage debt, manage risk, until the time comes where valuations work off and the stock that you, or your accumulation of what you did, will allow you to sit back and breathe and take it from there. When you're younger, that works really well. If you're in retirement or going into retirement right now with that regression, right, you got to look at it real different, don't you, Danny? Because your returns are going to be much lower over time.
You do.
So it depends on whether you're in accumulation where you're putting money away, you're a human capital working machine, or I'm in distribution mode. My human capital equation, me as an earnings machine, has gone almost to zero, and I'm living off my assets now, right? Which means if I am now in a headwind, I've got to watch my withdrawal rates, how much I'm taking out every year, because we talked about this on the radio show yesterday, Danny, right? But how long have we been talking about it at the Right Lane class? To ask for a fixed portfolio withdrawal rate from variable assets like stocks and bonds is like mixing oil and water. And the industry is finally coming around to the way we've been thinking for so many years. So yes, your 60-40 traditional portfolio is not going to give you 6, 7, 8% anymore. And you're going to have to rethink. Even if you want to stay in a 60-40, those returns are probably going to be about half. And there's nothing you're going to be able to do about that. There's nothing magical. You're going to have to work it from your household to adjust. Oh, honey, returns are going to be less, which means I might have to increase our savings rate because we have to compensate for that. What do we do? How do we work our budget now to increase our contribution to our Roth 401k? Roth, I said, 401k. What do we need to do to bolster our emergency reserve? Because we're not going to get the same stock returns over the next 10 years. But guess what? We're 32 years old. We're chickens. When it comes to the stock market, we're chickens. We're young chickens. We're running around wild here. At age 42, when I get a better market and I've accumulated all this because of my good habits, guess what happens, Danny? From age 42 to 52, wow, I did all this hard work up front, and now I have a tailwind. How beautiful is that?
It's amazing.
But for retiree, you got to go to the other. I call it the crossover risk. I'm on this side of the fence as an accumulator, and now I have to cross the fence to be a distributor. But most advisors are on this. They only know this accumulation. And they apply the rules on this side of the fence to this side of the fence. And you got to be careful, right?
But the issue is, even with that, from an accumulation standpoint, so many people strictly push traditional IRAs, 401ks, pre-tax dollars, put it aside. And that has gone on for years. And finally, we're seeing that, they're just coming up and saying, okay, well, what about, maybe now is a good time to put into a Roth or to bolster your emergency funds. Well, you should have been doing this for a long time. We look at all the things that are going on right now, the additional stimulus. You and I have beaten this down over and over again for years on bolstering your basically financial vulnerability cushion, additional funds in excess of the emergency reserve, putting funds into a Roth, looking at permanent life insurance for cash value if you have that ability. I mean, there's so many other ways out there that you can look to that are more, some of them may be more sophisticated than others, but a holistic financial plan should help you look at all these different avenues. And now, so, like you're mentioning the accumulation aspect, you need to start thinking outside the box. And it's not too late. It may be, but it's not at the moment. If you look at some of with the stimulus, with taxes potentially going up, with Biden's tax code, his tax policy they rolled out a couple weeks ago, go look at that. And you'll start looking, thinking, shoot, should I be doing a Roth conversion now? Should I be looking at these other avenues? Because I would suspect it's going to encourage a lot of people to say, okay, you need to do it. You need to do it quick. So I think that from the accumulation standpoint, it cannot be those old school rules of thumb. You have to go in and start to become very strategic in how you move forward and where you put assets. Because the issue is, like you mentioned, everybody tells you to accumulate, but then nobody tells you how to distribute, because it's never mattered. It's never mattered because all of your assets have been in one place, the 401k, pre-tax. We want you to have flexibility so that you can say, okay, you know what? Here's how this is going to work. Here's how we're going to minimize your taxes. Here's how we're going to keep more money in your pocket, because that's all it is at the end of the day. You know, I had a question yesterday, Rich. Somebody said, well, I'm really concerned, like overseas, I've heard of them coming and taking, retirement accounts or taking, assets. And I said, well, and that's very plausible. And he said, well, what do you mean? I mean, they're going to come and just take my account? I said, no, they're not going to take your account. They're going to raise your taxes. So now instead of you owing them 10, 15, 20% of that account, maybe it's 30, maybe it's 40. What if it's more, depending on where you are? So those are things that scare me. I used to have a lot of hair. I don't know if you can see, guys. This is what keeps me up at night. Terrible. So,
I can't believe I'm not completely gray based on what's going on over the last 10 years, but I'm not.
Or let me tell you that.
But I agree with you. Taxes are going higher. You have to understand this, and it's going to be very creative. Think about this. Your pre-tax IRAs that Wall Street's been telling you to overstuff all these years is the fatted calf. And the government's looking at these. And they're not going to come and just steal your cattle, right? That's not going to do that. But I'll tell you what we're going to do. We're going to work around it. We're going to find ways to make sure that we're tapping the fatted calf. And part of that would be, one, Danny's point, we tax federal income tax brackets. The ones in your face are going to come up. So maybe I'm changing the food of my calf who's overweight, right? I'm changing that. The other thing you have to keep in mind is, and Danny and I focus on this a lot, the backdoor taxes that no one talks about. Taxation on Social Security benefits, Medicare IRMA charges above a base premium. Those are based on your adjusted or modified adjusted gross income, and guess what counts into that income? Those distributions from your pre-tax IRA. They can play with those scales where you wind up paying more for Medicare premiums. You wind up having maybe 100% of your Social Security taxed. So they're not hitting you on the federal income tax level, but they're going around. They did it in December, Danny, remember? With the Secure Act, when they said if you have a non-spouse beneficiary on your IRA, my daughter Haley is the beneficiary of my IRA. Before December, Danny, as my beneficiary, what would she have been able to do if I pass away?
You know, take those distributions over her lifetime, which would
over her lifetime, right? She's 20 years old, right? Long distribution pattern. What did the Secure Act do to non-spouse IRAs?
So the Secure Act essentially it eliminated that ability to do so. So now you actually have to take those distributions if you're a non-spouse beneficiary within a 10-year time frame. So essentially, they're going to increase the potential taxation they're going to have on these funds. So where do most people, where do the elderly pass away? At what age group? How old are their kids? They're probably at their peak earnings capacity, 50s, 60s, maybe 70s if you're lucky, and you're taking to these distributions. So now think about that. If you have to take these out within that specified time frame, potentially while you're still working, making the most money you maybe have ever made, your human capital is extremely high, and next thing you know, you have to take these out, so your taxes go way up. They collect money quicker, and it doesn't give you the ability to stretch that out over your lifetime. So there's going to be more things like that, I believe, in the future. Right now they're talking about doing away with, kind of going back into Biden's tax policy, looking at going away with potential estate tax, with the exemption, which that could be big. There's a number of things that are out there. And I think that So I'm picking a little bit on Biden here just because this is what's most recently been laid out. No partisanship here by any means, because I think that it doesn't matter if you're a Democrat or a Republican. I think taxes are going to go higher. There's nobody's fiscally conservative. So we're going to see higher taxes at some point in the future. This is just the most recent thing that's came out. So Rich, just kind of keep this ball rolling a little bit here. Did get a couple of good questions here as we were going through kind of in where we were. We had one viewer say, so basically reduce expenses and be careful about investments. Absolutely. You can reduce expenses here. I think you're going to be in a great position. We have a lot of clients that they've actually reduced their expenses, didn't have to because our plan, we stress the funds for these types of events. They said, you know what? I'm not spending, I'm not traveling, I'm not going out, I'm not doing all these additional things. Go ahead and keep it in the account. Let's let these things, let's get past this next year or whatever it may be. But, another question was, is there an optimum mix or should it all be Roth when you're putting these funds aside?
That's a horrible question for me. That's a horrible question.
It is. But I'll give you an example. Years ago when I first started putting funds aside, I did half and half. And then
that's good.
The last probably 5 to 10 years, I said, no. We're going to start putting everything in Roth 401k. Try to utilize every avenue I can to skirt around having to pay potential taxes down the road. And there's no magic number, but I do think that you can look at this in you're going to have to get surgical. I mean, Rich, what would you do? You look at your tax returns, you'd see, where you are with taxes. Luckily we've gone away from AMT if you're a high income earner, pretty much.
Yeah.
Come back too.
Well, first I will tell you, Wall Street hates Roth. And it was a great article in Investment News from one gentleman who wrote that, you know why they hate Roth? Because they don't collect as much fees from Roth. So they turned it into advice. I will tell you, if I could do my life all over again, I would never, and I'm going to say this on the record, never own a pre-tax account again in my life. I followed the same advice, and I should have never done it. You have young children, and I mean young that they're working, they're 22, 23, Roth IRA, Roth 401k. Many studies out there will show you that even if you're going to be in the lowest income tax bracket in retirement, you will have more post-retirement consumption dollars in Roth than you will in pre-tax. The tax deferral, and I wrote an article about this in 2017, if you type in 401k in the search box in Real Investment Advice, the tax deferral aspect of the market isn't what it was during the great bull market. Every study we ever had about what to do came out in the greatest bull market ever. We might be in a market here that was from 1962 to 84, where inflation was higher and stocks did nothing for generations. Your tax deferral is going to mean nothing. We're all in this save taxes now kind of mindset when it should be, I have the money to pay the taxes now. If I get $2 in retirement and I'm in the 20% tax bracket or 15% or 12, whatever it might be, who knows then? But I'm able to keep that $2. And guess what? That $2, it doesn't generate taxes on my Social Security. So I get all my Social Security tax-free. It doesn't push me into a tier in Medicare where I pay more than the base premium for Part B. This is all needed to be taken into account. And that's why we are so passionate about doing surgical Roth conversions for clients, helping them understand that Roth has nothing to do or very little to do with what your tax bracket is going to be in retirement. It has nothing. There are studies out there, and the studies don't seem to make it. They go from academia and all these great places, and then they get to Wall Street and they die. We look at the studies before they die. So I will tell you, if I had to do it all over again, I'd own permanent life insurance and Roth. I have one client who has done this, and I would argue with him like an idiot. For 25 years, all he has done is permanent life insurance and Roth. He now will collect an income with Social Security of $120,000 tax-free.
It's amazing. That is awesome.
If I want $120,000 out of my pre-tax IRA, how much money am I going to have to take out? And not only that, if I take 120, I have 85% of my Social Security tax. It's a wave. And if you think any of those taxes are going lower, you're going to have to set your premise for me, because it's going to be tough to convince me otherwise. And we were saying this before all the fiscal stimulus, and there's going to be another package coming, another massive package coming. Yeah. That taxes are not going up for everybody. I don't care where you are on the income spectrum.
All right.
So Roth is not too late. Not too late. Roth is not a 4-letter word.
We got a handful more questions I want to try to get to, yeah. Rich. So I'm going to kind of speed us along here. So here's a great one. So in our newsletter, there's a 401k guide, and so it essentially shows kind of what we're doing, but on a slower pace, just because you can't move funds as quickly inside of that 401k. A lot of times, you'll have some parameters, time limits before you can make changes. So is a 401k balance in your newsletter appropriate? Is it best to use just one diversified fund, managed or indexed? I'll kind of start on this, Rich. So it's a little bit different for everybody. That just shows you what a balanced portfolio would look like in general. And our balance is going to be a little bit different than your traditional. If you just went and bought a balanced fund, that's because ours is going to be much more dynamic in nature. Most of those are fairly static. You go buy a balanced fund, it's either 50-50 or 60-40, and they rebalance every month or quarter, and it is what it is, which is fine. Whereas when we get, risk levels or asset prices, like looking at the Cape, get very expensive, so cyclically adjusted price to earnings, we're going to start to tone it back a little bit. Because we say, okay, prices are high. We start looking at the odds, the probability, saying that, well, we're likely going to see things maybe deteriorate a little bit or come down and get cheaper. So also when they're very cheap, we may get more aggressive in that nature. So the 401k guide, I think that it is appropriate to use as kind of a barometer or a benchmark, so to speak, and know yourself and know your scenario from your objectives, your retirement horizon. I mean, we've got a lot of things that you need to look at. So maybe you tone it back a little bit, or maybe you can increase it, but use that as kind of a benchmark there in that aspect. The diversification from a fund, usually what we see in these 401k are target date funds. And Rich and I, if there was something, I don't know that there's a lot that I hate more than target date funds when it comes to an investment. I guess there are, but there's a long list now.
You sound like Ken Fisher with annuities. I hate target date funds. I'd rather hate target date funds over annuities. But
yeah, well, I'm turning into a curmudgeon. I'm hanging out with you too much or something. So
my work is done.
Done. So the issue here with target date funds is that there's not that there's something wrong with them, other than that they're very misconceiving. And what I mean by that is that you may have a 2020 target date fund or a retirement income fund. That 2020 fund may be a 50-50 portfolio, meaning 50% stocks, 50% bonds. They're not all created equal. And so you have this kind of maybe misconception in most people's minds. And I hear this all the time from people saying, well, I thought I was super conservative. I was in this fund and it lost, 20%. It's like, whoa, well, okay, let's look under the hood and start looking at where you're invested. And a lot of times you're invested in every single asset class. You're invested in way more stocks than you need to be. And that's why I don't necessarily, not a big fan of target date funds. Now, if you do your homework, you know how to use them, I think they can be a good tool. And especially if you're too busy to manage the portfolio and you can't do anything inside that 401k and it's an afterthought, I'm okay with it, because you can manipulate and go between them probably easier than you can go and picking all these individual indexes or mutual funds. But know what you're invested in. Just because it says retirement income or it says, a year like 2020, 2025, 2030, that does not mean it's super conservative or even, halfway there. I don't know if you want to elaborate on that, Rich.
No, I mean, we try to provide the 401k fund manager as a as a beacon for you, to give you an idea of what we think you should do. We understand you are under constraints of how many trades you can make, investments that you own. We're trying to make that more robust for all the different types of retirement plans that are out there. Like if you email Lance and say, hey, I work for XYZ company, he'll add it to the database and give you more specific advice. So we're trying to tackle all these plans. I don't know if Lance is really sleeping anymore, but I really don't think he does. I think, he's always writing something. So we have to keep this in mind that these target date funds, the years should come off these things, because people think of those years in those life path target date funds as maturity dates. They mean nothing. You got to look under the surface. So what I try to tell people is, like, if you want to match our 401k premise, where we are now, you look inside all the target date funds you have, and take some work and look at how much they have in equities versus bonds. And it might be a 2020 fund. And you're going, I don't get it. I'm not retiring 2020. Doesn't matter. Blank the year out. Just go each year, 2021, 22, 25, whatever they're available to you. See what matches or aligns. Because we don't change that 401k manager allocation too often. So you could probably sit with that one. But then if we expand our equity exposure, you can go back to look at your life path or target date fund and say, oh, this matches more to 2030. So I'm going to move from this 2020 to 2030. So maybe every 6 months, I think, would be a better gauge as opposed to you looking at every week. Lance has to provide it every week because people are in different cycles. But to me, I wouldn't do it. I would put it on my calendar that every 6 months I'm going to look at the 401k manager, where I am, and adjust. And I can use the target date funds to do that if I forget the target date and I look inside the fund.
I'd probably suggest a little more frequently. That's just me. But 6 months is good. 3 months is okay. Whatever. Yeah.
Listen, to your point, Danny, every week seems too much, but if you did it every quarter, come up with something that works where you can actually do it and make a change, as opposed to, I'm frantic, I can't do it. You know what I'm saying? Up with the schedule, but I think you want to give it a little time in between.
Yeah. You'll smooth that
6 months, but other people might be a quarter. But as long as it's not every week, that's really your personal preference.
Yep. All right, we're going to keep this moving. We got a handful more questions in about 10 minutes. So, one thing, let's spend 2 minutes on this. Education savings. So you have your emergency funds, you've got everything set up with that, you're saving for retirement. Now you need to go out and do some education savings. And 529 prepaid tuition college plans, what do you like?
I personally like 529s. I like the Vanguard 529 a lot, as long as you make your choices and so forth. Having a daughter in college and who does have a 529, it's nice to be able to tell her or have her not being able to tap those funds. Because as good as she is with money, she gets real creative. Dad, how about this? Does that come out of my college account? I'm like, no. So in other words, the 529 allows parents to still have a hold and invest the money the way they like. On the prepaid, it's nice if I know what school I'm going to. You also have to look at the financial viability of these. Not that I'm worried that states would tap these, but states are going to change how they do these things because, let's put it this way, a lot of states are hurting financially. Not just hurting, bleeding to death. And I have no idea what's going to happen to their pensions and so forth, everything that they're doing. The internal fiscal structure of many cities right now, they're being decimated. I don't know if these prepaid plans get tossed into the mix. I'd like to think not, but I would rather be independent with it and look at a 529. I think that's the way to go. You got to be careful though to college plan before, because you might tend to overfund these accounts. Then you need to figure out, well, now, which has been my case. I did the planning, but Haley got all the scholarships and all that, so we're not spending as much in there where we still might have a substantial amount of dollars. And I've got to figure out, will she go back to school? Can I take it back? You know me, Danny, I'm always in school, right?
Yeah.
Can I use it? So as opposed to taking the money out for a post-secondary education expense, and then I'm going to have to pay taxes and a 10% penalty on that money. So you got to want to do careful planning and then look at the right 529 and not these 529s that are loaded. There are many broker-sold 529 plans that are very expensive. Stay away. We can give you an idea. Fidelity has a really good one. Vanguard has a Nevada plan. It doesn't matter what state. Like Haley's plan is out of Kansas. It doesn't mean she has to go to school in Kansas. It's just the state that helps administer along with the fund company. But this money is yours. It's not like a prepaid. The 529 plan is two legs. It is this prepaid. Well, the prepaid plans are that prepaid, and then there's also the 529. But if I had to pick one leg, it would be the 529.
All right, we're going to finish this up. One thing to keep in mind, you mentioned states. If you live in a state with state income tax, there could be potential tax benefits for you using your state plan. So
that's right.
That's right. States, keep that in mind. You don't want that flexibility of using them. Like us in Texas, we can use any of them because there's no tax benefits for us actually making those contributions. So,
right.
Okay, we're going to move this along. Got a couple minutes left. Annuities. It's been a hot topic. One question was I've been working with another advisor who's pushing annuities. It's a place to park money on the sidelines to protect principal for 10 years. The money is tied up for 10 years. What are our options for money that we do not want exposed to the market? He said buying bond funds are not good because bond prices are at all-time highs. Not a fan because of the complexity and the lack of access to funds. Let's do this one for 4 minutes.
Go ahead. You start.
So annuities are something that we've had to look at. Annuities is a love-hate relationship. And here's the issue. There's a lot of guys out there that are not true advisors. They're salesmen. And you may hear me use this term often where if all you have is a hammer, everybody's a nail. It doesn't matter your age. I mean, Rich, you and I have a little bit of age difference between us, and I guarantee we could sit down with one of these guys and they try to sell you and I the exact same product. That may not, and somebody 20 years older than you and 20 years younger, and everybody, and I've seen it all. And I think that's really get a bad rap. The complexity of them as well is that I have so many people come in with annuities and say, well, explain this to me. Most of the time they explain it incorrectly because their broker explained it incorrectly to them. So I do believe annuities can be a good alternative in this environment if you can find one that maybe gives you a fixed rate of return, if you can use it for income. Now, this is not an all or nothing. I see people put everything they own in something. This is for a small portion. This is to hedge. This is for longevity risk if you get an income annuity or a deferred to give you certain types of guarantees. They can be good, but you want to be with a reputable company, number one. You want to be with a product that you understand, that your advisor understands and can explain to you. So when you walk out of there, you can lay your head down at night and not think, oh my God, what did I just do? And that happens, unfortunately, quite a bit. So I don't want to frown on annuities. And one thing we do say often about it is they need to be planned for, not sold. Now, with that being said, we talked about this earlier in the week, is that a lot of annuities, there are actual financial planning software that plan for an annuity where you're going to need one, right? So you do have to be careful with that. But I think it's for a small piece of the pie in certain ways. I think it can be great. In fact, we've used them sparingly. And, you could probably, a lot of clients, our job is to really to uncover and lift up every stone. And so if it's the right fit for somebody, that maybe that we'll bring it up and say, hey, here's an option. But I don't think it's there's no one size fits all. You need to look at every option and alternative that's out there at the moment. You need to be cautious with this because these too often are sold, and that's where we have the big issue with them. In fact, go to realinvestmentadvice.com. Rich wrote a fantastic series on annuities, the good, bad, and the ugly of every different type of annuity, the ins and outs of it, the pros and cons, and you can get a very detailed synopsis of what they all are, what you should look for, what we like as a firm, and what we don't like. But unless you have something you want to elaborate, let's move on, Rich. So
annuity. Let me just say this: annuities are not a bad thing. They're taught to be bad. Annuity
correct.
Means lifetime income. Social Security is an annuity. Your pension is an annuity. It's just whether or not you need it. And that's where a plan comes into place. The industry has just really destroyed what annuities are supposed to do. but not everybody needs them. And matter of fact, more people are looking at them now and asking me, Rich, you think I need an annuity? And I'm like, whoa. And I had to tell some people, we just ran your plan. No.
You don't need one.
If I was selling annuities, if I was really in the selling annuity business, I'd be like, hey, oh, yeah, you need an annuity.
Well, what happens is you start pulling on these emotional strings, and it's a sales pitch, and that's what drives me nuts. I'm probably a terrible salesman because I just lay the data out there and the information, like, here's what it is.
Yeah, me too. Yeah. So I like
that,
annuities in the right, but not all annuities are bad. So to Danny's point, if you want to read the articles on how annuities can fit surgically into your portfolio and planned for as part of your holistic financial planning process, they're not difficult studies that I've done, but just something you can maybe bring to your annuity salesman. Say, hey, look at this. So blame it on me. Blame it on me. I'm fine. People blame everything on me.
I had somebody not long ago, we did a small portion, I don't know, 10 years ago, and he's like, man, why didn't we do more in this? I was like, well, we want to use some guardrails as well there, where we're not putting all your funds in something like that. Create a floor for income to cover, your necessities, things of that nature, or maybe it's a debt fund you don't need. There can be some very good. There's some good aspects to them. So a couple minutes left. For self-employed people, how can they save in a health savings plan? I never had a health savings plan because my employer did not offer it. So that's good and bad. Your employer didn't offer it because you were not on a high deductible health plan, meaning your deductible wasn't very high. If you are self-employed and you are on a high deductible plan, you should have access to, or you should be able to create your own HSA. Check with your benefits provider. Shoot Rich an email, shoot myself an email. We can look and determine if it is. You can go out and create your own HSA. We love this account. This is the best account in the world. I wish you could put more money into it. If you're single, you can put in $3,550 for 2020. If you're a family, you can put in $7,100 for the year. The greatest thing about that money, it goes in tax-free. It grows tax-free. It comes out tax-free if you use it for medical expenses. The idea would be is to use that down the road, not now. Pay your medical expenses out of pocket, but use that in retirement, because we know the number for retirement are huge, what you're going to spend on healthcare.
And keep in mind, these HSAs are not what we call FSAs. These are not use them or lose them accounts. These are retirement. These are retirement 401ks. You can allocate your funds, and we tell people, if you're putting money into an HSA at work, or your children or grandchildren going to work in the world, they're going to have a high deductible plan. I wrote this in my book in 2012. Like 2025, 2030, almost 1 out of every 3 people are going to have a high deductible plan, because corporations are going to want to put more of the healthcare costs on their employees. Max that out and don't touch it. Don't treat it like a checking account, because that money can grow tax-free, to Danny's point. You could use it in retirement for healthcare. As your healthcare expenses rise, will be completely tax-free, and it will not trigger Social Security tax, Medicare IRMA charges.
Yep.
So keep that in mind, that account should be looked at as a 401k for healthcare, a healthcare retirement 401k. I can only do that after a cup of coffee, by the way.
We are right at an hour. We're going to address a couple more questions real quick. So how do precious metals fit into the portfolio with bonds at zero? We're not looking at it as a bond alternative, but more as a hedge or some place to provide opportunity. There's a fear factor to some of this. There is some other aspects that you look at precious metals. Gold hitting a new high right now. I mean, you got to be cautious. It's time to take profits. Do you continue to put more in because you think the market's going to drop? I mean, I think there's a number of things that you look at here in that scenario. But precious metals do fit in a portfolio. It's not an all or nothing. I see a lot of people, they put everything they have into gold or silver. We like to think of them in smaller increments, probably no more than 5%, maybe 10, if you really, really have a high conviction in it. We're probably not ever going to put 10 into a precious metal, but smaller increments.
I think we're done, Dan. I think we rest our hour, but I will tell you, we want to do this next and remember, August 8th, Retirement Right Lane webinar.
Yep.
First week of September, that first weekend, we're going to look to do another Candid Coffee. We'll keep track. We'll have our wonderful associate, Nikki, keep track of the questions we didn't answer so that we can come back and address them. We didn't get to all of them. I just hope that you all found this helpful to clarify some things. But again, questions at RIAadvisors.com and for the next Candid Coffee.
One last thing, Rich, we did get a couple people asking how we work when we manage portfolios. We do charge an assets under management fee it's all inclusive of everything that we do. So financial planning, the Roth conversion, Social Security maximization, accumulation strategies, distribution strategies, all these things come together very holistic. We look at benefits. We look at everything you can think of financial. That is our job. So if you want to get more information on that, go, contact Rich or contact myself. It's either Richard or Danny at RIAadvisors.com. We'd love to help you answer any questions that you guys may have. Thank you again for hanging in there with us this morning. We're going to do this again, like Rich said, on the 8th. We do have the Retirement Right Lane. Go sign up, realinvestmentadvice.com. Thank you, guys. Enjoy your weekend. If you're in Houston, stay dry. Y'all have a good one. Thank you.
Thanks for joining us this morning for Candid Coffee, a production of RIA Advisors. If you'd like Rich and Danny to address your interests, email us at questions@realinvestmentadvice.com. Thanks for watching.